You'll find the link to beginner Web3 security guide in the description and pinned in comments below. Most people think limited supply is the same as easy money. They are wrong, and that mistake has ruined more portfolios than hacks, rug pulls, and bad advice combined. In this video, we'll dismantle that myth. You will learn the exact signals smart investors use to separate real scarcity from marketing. You will learn the one quick check that prevents catastrophic losses. You will get a checklist you can use before you hit buy. Stay with me because by the end, you will have a rule that turns chaos into predictability. If you want clear, data driven crypto lessons that cut through the noise, hit subscribe now. I post investigative explainers and systems every week. Limited supply means a cap on the total number of tokens. That sounds objective, but the reality is messy. Some caps are real, others are legal fiction. Think of it like a vintage watch. If only 100 were made and never more will exist, scarcity can drive value. But the manufacturer can press more anytime. Scarcity was only a marketing line. There are three common supply node models you will see: truly fixed supply, capped but mintable, and inflationary. Bitcoin is a classic fixed supply example. Many new tokens appear fixed but include hidden minting or owner privileges in their smart contract. Here's the danger: if you buy a token because it feels rare, but the developers can mint billions more tomorrow, you're holding fiction. That fiction collapses markets. Supply alone won't move prices unless demand shows up. Demand has many faces. There are four real drivers of demand: utility, speculation, institutional adoption, and engineered scarcity events. Each behaves differently. Confusing them costs money. Driver 1: utility. This is where people need the token to use a network. People use it for free for fees, staking, or accessing services. Utility demand is often steady and defensible. Driver 2: speculation. This is emotion driven buying, fear of missing out, and hype. It's fast, loud, and dangerous. Driver 3: institutional demand. When funds, ETFs, or major custodians accumulate, they can move markets with deep pockets and longer horizons. Driver 4: engineered scarcity. This comes from burns, halving events, or planned buybacks. These can be real, but sometimes they are PR events. Which of these do you want exposure to? Utility and institutional demand are the more predictable options. Speculative and PR driven demand is a coin flip. Imagine a remote island that grows 100 rare apples a year. If tourists come for the taste, prices rise slowly and sustainably. Now imagine a celebrity posts a photo of the apple and everyone rushes in. Prices spike and then fade. The apple didn't become more valuable, attention did. Crypto behaves the same way. Scarcity multiplied by sustainable demand grows value. Scarcity multiplied by hype collapses it. This token launched with a tight supply and a viral community. Price doubled, tripled, and headlines shouted moon. Then, in one awful day, the price fell 90%. The launch looked perfect: small, max supply, charismatic founders, influence push, but the white paper hidden in plain sight contained a schedule: large team allocations vesting after 6 months. Those tokens were locked, but not locked for long. When the unlock date arrived, a wave of previously illiquid tokens hit exchanges. Liquidity couldn't absorb the sell pressure. Price collapsed, not because supply suddenly grew permanently, but because a large portion of supply became liquid in one day. If you had checked the vesting schedule, you would have seen the cliff and acted differently. That single check is the difference between riding a trend and being crushed by it. Here are three fast, non technical checks. Anyone can run them. Check circulating supply versus max supply. Inspect vesting and unlock schedules. Verify liquidity. Check 1. Circulating versus max supply. Many tokens have a huge gap between max supply and circulating supply. That gap often hides future inflation. Check 2. Vesting and unlocks. Look for dates when large allocations become tradable. If major holders unlock in the near term, expect downward pressure. Check 3. Liquidity. Look at order book depth. Shallow order books mean big trades move price dramatically. If you can't exit a position without 10% slippage, rethink the trade. Do these three checks before you buy. Most beginners believe low supply equals easy profit. That's the rookie trap. The truth is, low supply with low liquidity is a prison. Imagine buying 10% of the available circulating tokens. You think you have got a big position, but when you try to sell, market makers disappear. Your exit becomes smaller than your position. Price collapses as you try to leave. Liquidity matters more than supply for your ability to realize gains. Always evaluate both. One line rule: only buy limited supply tokens when circulating supply is stable. Vesting unlocks are a long term. Locked liquidity supports your planned exit and the demand driver is real. Prefer utility or institutional demand over pure hype. If any of those aren't true, don't buy. Step 1. Confirm circulating supply and check for suspicious minting functions in the smart contract. Step 2. Read the vesting schedule and calculate how much unlocks in the next 12 months. Step 3. Check 30-day average daily volume. If it's less than 1% of your planned position, reduce size. Step 4. Determine demand type. Utility and institutional signals are stronger than hype. If you plan to invest $1,000 and daily volume is $200, you are already too large. Accept slippage and avoid it. This checklist isn't a guarantee, but it moves the odds in your favor. To trade efficiently, you must understand why demand forms. It's rarely rational. Emotions drive price more than fundamentals, especially in early stage tokens. Three psychological forces dominate: fear of missing out, confirmation bias, and loss aversion. Fear of missing out pushes people in confirmation bias keeps them blind to danger. Loss aversion makes them hold through collapse. Behavioral edge: set rules before you trade. If you are tempted to break them because of hype, the market is winning. Make your plan mechanical. Position sizes, entry points, take profit levels, and stop rules. The market doesn't care about your feelings. Your rules protect you. Exposure without gambling. That's the goal. Here are practical tactics used by cautious investors. Tactic 1: scale in. Don't commit your full allocation in one trade. Buy in small increments over multiple days or price points. Tactic 2: take partial profits on spikes. When a token doubles, take 20 to 30% off the table to lock gains. Tactic 3: position sizing tied to liquidity. Only allocate what you can exit with reasonable slippage. If you can't exit 50% of your position within a day without pushing price 5%, reduce size. Tactic 4. Hedging. Advanced but powerful. Use futures or options to protect against downside while keeping upside exposure. These strategies don't make you rich overnight. They preserve capital so you can trade again tomorrow. That's how compounding works. Now I'll run the 3 checks live so you can follow the steps. I'm using a generic token page and a block explorer. You can replicate this. Step 1. Check circulating versus total supply. If circulating is far below max supply, drill into the white paper or contract to find why. That difference could be future dilution. Step 2. Inspect the vesting schedule. If the team or private investors have large unlocks within a year, treat it as a red flag. Projected liquidity can change overnight. Step 3. Check liquidity. Look at order books and recent trade sizes. A quick rule: ensure 30-day average daily volume comfortably covers your intended exit over a week. Do this before you click buy. Altogether, the biggest insight is this: scarcity matters only when it meets reliable demand and liquidity. If any of those pillars is missing, scarcity can become a trap. Follow the 4-point rule: stable circulating supply, locked vesting, sufficient liquidity for your exits, and dependable demand drivers. Say it out loud: check supply, check vesting, check liquidity, check demand. Do this consistently, and your decisions move from gambling to calculated risk taking. You will stop chasing headlines. You will avoid the panic sells. You will keep capital for the next opportunity. Final checklist. Before you buy, confirm circulating versus max supply and search for mint functions. Read vesting and unlock schedules and flag all unlocks in the next 12 months. Verify 30-day average daily volume and order book depth for your planned position. Identify demand driver. Prefer utility or institutional signals. Set mechanical rules for entry, profit taking, and exits. If this helped you, subscribe now for more investigative crypto explainers and systems. We break down messy tokens into clear signals so you don't lose money learning the hard way. But before you trade again, watch the next video. Beginner friendly trading system overview. It pairs with today's checklist and shows step-by-step risk-managed system you can start using right away. Click it now. It could save you your first portfolio. Do the checks, trade small, protect your capital. See you in the next one.